Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, February 24th, 2021, and I am pre-recording this Trading Places Live for Thursday, February 25th. Currently, futures are up slightly, a little bit more on the Dow Jones than on the S&P and on the NASDAQ. The Dow Jones touched 32,000 for the first time in history today. We'll look at that in just a couple minutes, but given futures where they stand right now, we may be above 32,000 tomorrow on the open. We'll have to see. Before I get into all of that, let's walk through the agenda for today. Do have that daily market recap. Always like to start off with the daily market recap. Then we'll get into talking technically, sector analysis, earnings spotlight, and we'll wrap the show up with the three you must see. Before we get into any of that, let's take a look at earningsbeats.com. If you are new to the show here, first of all, welcome. I'd love to have you join our Earnings Beats Digest newsletter. We've got a growing community. Love to have you join. Just simply type in your name, email address, hit that subscribe button. We do publish our newsletter 3 times a week, Mondays, Wednesdays, and Fridays. It's very brief, usually just a couple paragraphs, talks about a stock, maybe an industry group, could be an upcoming earnings report. We tend to focus on earnings, relative strength, those types of things. But I'll give you an idea of how we look at the market. And I think it'll be something that's very educational and can help in your trading. While you're at Earnings Beats, if you want to try our service, right there, the green Join Today button. You can see below our portfolios, how they've done. This quarter just started for us on February 19th. We've got some growth stocks, which clearly took a hit earlier this week and continue to struggle a little bit, but on a relative basis, not so bad. Income portfolio actually is doing very well relative to the S&P 500. So at least we do have that one piece that started off pretty good. But if you look at our since inception returns, I think our portfolios have done spectacular over the last couple of years. So I'd love to have you sign up for our service. It is a no-cost 30-day trial. So you sign up, you pay $7. We refund you the $7 within a week, and you can enjoy our service for 30 days. Love to have you. All right, let's move on to the daily market recap. So I mentioned the Dow Jones hit 32,000. We got as high as 32,009. We closed at 31,961. This was your leader, though, among the Dow, S&P, and NASDAQ, with the Dow rising 1.35%, S&P 1.14%, and the NASDAQ just about 1%. Mid caps and small caps, though, performed very well again. So mid caps up close to 2%. Small caps about 2.75%. So really nice action. And as I keep mentioning, check out the AD line. Literally just moving straight up now, especially look at the Dow here in February. This has been a huge run straight up in the AD line. So we're closing in the upper half of candle bodies. That's how you get positive AD. And you can see we've had hardly any pullbacks in February. So I think the action here certainly is lining up for stocks to continue to go higher. Energy continuing its torrid February. We were trading down below $40 to start the month. Now we're over 50. Huge month. That's 25% in this month alone. So really great action there. Financials also performing exceptionally well here in February. Industrials gaining strength, breaking out. All of these, the AD lines looking strong. Then you've got technology, which had been struggling a little bit, went back to its 50-day moving average. Beautiful day today, though, up 1.5%. And look at the AD line. Even though we've been going down, AD line breaks out to a new high. A lot more accumulation taking place in technology than you might think simply by looking at the price action. Utilities back down close to that $60, actually right on that $60 level, which has been pretty good support. And I would expect it to continue to hold. But look at the AD line on the utilities. Not any accumulation taking place there. At least it certainly doesn't appear to be that way. 10-year Treasury yield. First of all, we do have a number of economic reports coming out on Thursday at 8:30 in the morning, 8:30 Eastern. January durable goods expected to rise 1.1%. December was a rise of 0.2%. So we're looking for that to pick up. And then January durable goods, if you exclude transports, expected to rise 0.6%. December was 0.7%. So we're looking for a little pullback there. And then finally at 8:30, the Q4 GDP second estimate, looking for 4.1%. Initial estimate last month was 4% even. So we're looking for just a slight move up there. Initial jobless claims, 815,000. Last week, 861,000. So we're expecting that to come down. And then at 10 a.m. tomorrow morning, January pending home sales. Flat is the expectation. December was actually a reduction of 0.3%. A lot of these home building and home related reports, though, have been stronger than expected. So while they're expecting a flat report, I don't know, I wouldn't be surprised to see a positive number coming out there. Looking at the 10-year Treasury yield, I mean, we continue moving higher. This is good for the market. The 10-year Treasury yield, which went up above 1.40%, got as high as 1.435 on Wednesday before settling back at about 1.39. We've had a huge move. I do expect we'll see a pullback probably fairly soon. And I'd be looking maybe for a move back down to about 125, 130. But overall, this uptrend bodes very well for stocks because it's telling us that money is continuing to rotate out of treasuries. When the yield's going up, treasury prices are going down. Always an inverse relationship. So you got to like it when yields are going up because money's coming out of treasuries. That money can then go into the stock market. So we're not just getting new money into the stock market, but we're seeing rotating money. That's really important. All right, let's move on to talking technically. And I'm going to go through the major indices here with you. So we start off with the Dow Jones AD line. This is on a weekly chart. This is a 5-year weekly chart. And we had that one little scare back at the end of October, early November. Actually, we rebounded early November. It was really the end of October where we pulled back. Looked like we were breaking down and then came storming back to the upside. Got the virus vaccine news the beginning of November. That sent the Dow flying to the upside, breaking out to another all-time high. And now we just continue churning to the upside. This is very, very solid action here in the Dow. The S&P 500 on the long-term weekly chart. Basically the same thing. Had a little false breakdown at the end of October, but otherwise we just keep trending higher above that rising 20-week EMA. So I think the S&P 500 is heading for its first close over 4,000. I think that's going to be sooner rather than later. Then we can pull up the NASDAQ. The NASDAQ had certainly a rougher week this week. It has rebounded quite a bit off its low. It was down as low as 13,003. Closed on Wednesday, 13,598. So we are talking about quite a reversal there, nearly 600 points off the low. So it's been a volatile week on the NASDAQ, but no breakdowns here. I mean, even the selling earlier in the week when we got down to that 13,003 level, you can see that was still above the rising 20-week EMA, and we have not had a single close below that since we came out of the pandemic. Early May, maybe even late April, we broke out above the 20, and we've been holding it ever since. So I'm continuing to like what I see here. Let's pull up the small caps because small caps been the best of all. Now, let's go back and look again at the NASDAQ because the highs that we saw in 2018, we took that out in 2019 and into 2020. You see the higher highs, pulled back. We held those prior lows. Now look at the small caps, completely different picture. Here was the high in 2018. We never broke out again. And when we pulled back with the pandemic, we went way below that trade-related low in the fourth quarter of 2018. So we were starting off from a much weaker position in the small caps, but we have since absolutely exploded to the upside, more than doubling since the low back in March. Very strong, very, very strong. So the S&P 500, remember, went down to about 2,200, just below 2,200. So for the S&P to double off those lows, it would have to get to 4,400. So the SML, it was below 600. So all it had to do is get to 1,200. It's over 13. So the relative strength continues with small cap stocks. I continue to like small caps quite a bit, and I think they'll continue to lead us here in 2021. All right, moving on to sector analysis. So I'm going to go through some of the sectors here and give you, my take looking at a daily chart here on technology. When we came back down, and it's been a rough, 5 to 7 trading days. But notice the last 2 days, we've closed near the high of the day with heavier than normal volume. That's really important because we've seen weakness in the morning, but we don't see that weakness continue throughout the day. Instead, we see buyers coming in. The reason I point this out, I want you to look back at March of 2020 during the pandemic. Do you see these lows? We kept going down. You see those hollow candles finishing a lot of times in the upper half of the candles. So as prices kept going down, what we saw was the AD line continuing to go up. That's what I talked about almost a year ago in terms of remaining bullish and the fact that institutions were accumulating, even though we were seeing all these big gap downs and price action kept going lower and lower. Well, technology stocks were accumulated back then. To a lesser degree, that's exactly what we're seeing again. We're not seeing the huge steep drop. We're not seeing that kind of panic. But we did see volatility pick up this past week. This is options related, in my opinion. But we went down and tested the recent low, put in a nice reversing candle right on the 50-day moving average. This was the first time, by the way, we moved below the 50-day moving average since all the way back early in November. So it's been a while, almost 4 months. But we did go below the 50. We reversed off of it. And now it appears like we want higher prices on technology. And that AD line, to me, kind of underscores the fact that the market remains very bullish. XLY, consumer discretionary, same thing. Testing the prior low, went below the 50-day moving average for the first time since early November. AD line breaking out, even though price action's been coming down. I see very similar characteristics. And then the other sector that I really wanted to take a look at was the communication services. Because when I look at communication services, I'm seeing a really healthy group. I mean, we broke out. We didn't go down to the 50-day or below the 50-day like we did with technology and consumer discretionary. Here, we tested the 20-day and we tested this breakout level. If I annotate this, I think you can see we basically went right down to that breakout. You see that high? We pull back to the 50 and then we break out. Look at the volume pickup on the breakout. We went right down, and right here on Tuesday, we tested that breakout level. So communication services, I think, looks exceptional. I see no problems here whatsoever. And the AD line has broken out just like it has on both consumer discretionary and technology. Now, the other two aggressive groups, financials. Check out what financials are doing, breaking out. Look at the AD line. I mean, it is just powering to the upside. I see a lot of accumulation taking place in the financials. And then we've got industrials. Industrials just breaking out to a 52-week high on the AD line. Also, look at all this sideways consolidation just starting to break out. I think that industrials look really good here. So those are your 5 groups. And even the ones that pulled back, technology and consumer discretionary, they are breaking out on their AD lines. So the only movement to the downside for the most part is just the opening gaps. And then we're turning around, going right back to the upside again. That, to me, is a sign of accumulation. You're getting panic. Well, maybe not too much panic, but you're getting definitely action to the downside. I'd say there was pretty good panic in the market on Tuesday morning, maybe not as much Wednesday morning, but the recoveries have been nice, and we are, continuing to break out. So those were the sectors I wanted to go through. I wanted to go through those 5 aggressive groups. Now we could also pull up the energy group, the XLE, and you can see $45 over here, June 8th high, $45 mid-January high, and then finally we gap up and break above, and we are moving up, volumes picking up, and look at the AD line soaring. So, that's 6 of the 11 sectors that we just, I just brought up. How about, let's do materials. Look at the AD line breaking out. Price action hasn't broken out yet, but we are trending above the 20, which is above the 50. I think materials look fine. That's 7. And those are all of the aggressive and neutral sectors. The only thing left are the defensive. And yeah, they're not doing as well, but in a secular bull market, they don't do as well. So everything is lining up as though we are in a secular bull market, which is what I continue to talk about. So I expect that we're going to see higher prices. Now, the bigger question to me, as I've been talking about in recent days and weeks, it's not whether we go higher. I think we're going higher. For me, I'm certain we're going higher. Not 100%, but I'm pretty close to it. I feel pretty strongly that the market's going higher. But the question is, what leads? I think all of the groups I just talked about are going to go higher. All 7 sectors, I believe, are going higher. But which ones are going to go up the most, say, over the next 3 to 6 months? That is the question I don't know that we can answer just yet. I do expect over time technology, consumer discretionary, communication services to do their thing, which is to lead during secular bull markets. But in the very near term, and I'm talking again just these next couple months, do we see some of the stocks that struggled last year that are starting to get some love? The hotels, the gambling stocks, travel and tourism, those kinds of areas within discretionary. Are those the ones that are going to lead for the next few months? I think it's hard to tell that at this point. I still love discretionary, but which areas within discretionary? That is the bigger question. I think everything's going higher, but where is the leadership going to be? And that's what we want to keep focusing on, keep watching. All right, let's move on to the earnings spotlight. Number of companies reporting after the bell, and some big ones. We're going to start off with NVIDIA. So NVIDIA came out after hours and reported $3.10 in earnings, and $2.80 was the estimate. So a nice beat, more than 10%, but the stock's down 2% after hours. So it is looking to probably open down about 11, 12 bucks, or at least based on what's going on here on Wednesday evening. So we'll see what happens in the morning. Now, pullback, I think anything back down close to that 540 area. 50 days at 544. So anything as we get closer to that level, I like it. I do think that semis are going to go higher. NVIDIA is not one of the better ones, as you can see here on a relative basis. I think there are a whole lot. There's a lot of other semiconductors that look a lot better to me than NVIDIA. NVIDIA was starting to show some strength, but pulled back. Earnings, down a little bit with earnings. I think it'll do well because I think the whole group goes higher. But I think there are others like Micron and Applied Materials, and some other smaller semiconductors that I believe will outperform NVIDIA as we go forward. But I like NVIDIA, and I think NVIDIA's got certainly a solid long-term outlook. All right, how about Booking? Now, Booking reported, and you can see the breakout here in February. I'm going to point something else out to you in just a minute. But we got the breakout. They were expected to lose $5.08. They lost 57 cents. I had to look twice to make sure that wasn't a typo. They were expected to lose $5.08, and they lost 57 cents. That's a pretty big beat. Stock was only up about 1% in after hours, but I mean, it's been going up. So I think the market was anticipating this report. But the other thing I want to show you here is, and this is one of the most amazing seasonality charts in the market. And when we look back over the last 20 years, look at February, March, April, and May. February, March, and April, I mean, you can see we go up those 3 months, just, 80%. That's, roughly 4 out of 5, 3 out of 4, 4 out of 5 years is essentially what that's telling us, that these months go up. The average return over the last 20 years, February has averaged going up 9%. March 5.1, April 5.5, May 4.6. That's the average monthly return. These next 4 months, I mean, we're in February right now. So when you look at this chart, look at what has happened here starting in February. I mean, this isn't new. This is what booking does. It tends to go up February through May. So with the breakout, I would have to say booking looks really good to me as we go forward. AD line turning up, trying to break out. Price action already has broken out. It's beginning to show relative strength versus the travel group. I mean, I like Expedia better on the chart, but again, booking historically really likes these next few months. All right, next up, how about network appliance? NTAP. And that's not what I wanted. All right, so NTAP been moving up, looking pretty good. AD line's been pretty strong. Relative strength versus computer hardware has been good. Computer hardware has actually been struggling now for the last 4 weeks or so. Relative to the S&P 500, it was very strong at the end of January, but the last 4 weeks it's been going down. Now I do expect we're going to turn back up. I mean, we've seen this before. Saw this back in September. And then we kind of went sideways, started to roll back to the upside again. I think we'll see something similar to that. But NTAP not looking good after hours. They did beat a $1.10 versus a $1.01, $1.10 versus $1.01 earnings. But stock's down 6% after hours. So, I mean, we're talking about maybe $4, $4.50 pullback. We were up near, it's 52-week high, maybe all-time high. I'm not sure what the all-time is here. Let's pull up a 15-year monthly chart. No, not quite. So you can see there back in 2018, we were up around $80. So we still got a little bit of work to do there. But anyway, NTAP looks like it's going to probably open up a little bit lower. Another company that's going to open up a little bit lower is Teladoc. Teladoc missed its estimate. So the estimate here was a 25-cent loss, and they actually posted a 27-cent loss. So Teladoc, and if you look at the relative strength, it had started to pick up again versus software. It was near a 52-week low before it had this recent strength. But the stock is down 6% after hours. So we're talking about another $12 or so, 13 from this. So we're working our way back toward 240. And that was where we had a lot of tops in here, 240, 245, 250. So looks like we'll gap down in the morning, and then we'll have to kind of wait to see what happens from there. Do we gap back, or do we, rally off of that gap lower? How about Redfin, RDFN? So Redfin came in, posted 11 cents earnings. Market was only expecting 5 cents. So more than doubled the expectation. And this is a stock that looked pretty good relative to its peers. The stocks where its peers have been going up. Stock relative to the S&P good. AD line, it was pulling back, but starting to roll back to the upside. Wall Street not overly impressed, even though they did more than double their earnings expectation. Redfin down 6.25% after hours. So another one that's looks like probably $5, $6 down at the open. That would take us back below that 20-day moving average. So, and that's right about support too. So let's see. I'd really like to see this stock bounce after a gap, after it opens lower. But you can see we can't come across here. It looks like at about 82, 83, and we're probably going to open just a little bit above that. I would like to see Redfin finish strong tomorrow. All right, let me give you one last one that was very strong after hours. Came out with a really good report and got a very nice reaction as well. And that is Tandem. So Tandem Diabetes Care. And this one had not been performing well. So a little bit of a surprise here. But they came in 24 cents. The market was only expecting 13 cents. Now, medical equipment, I mean, it's been trending higher, but on a relative basis, medical equipment is down at its lowest level probably since June relative to the S&P 500. So money is rotating away from this group. The stock is up 14% after hours. So, we're probably talking 12, 13 bucks, which doesn't get this stock out of the woods, by the way. I mean, we're going to, unless we open above 105, that would be the level I'd be watching. Let me see. 105 even. So if it opens below 105, this is what I would do. If it opens below 105 and then goes through 105 and I was in it, if I owned it, I would have my stop back in below the open. So in other words, let's say it opens at 104, goes to 108. When it gets through that 105 level, I would put my stop in below the opening price. Just because I think if you get that false breakout, you just want to take your money. Because again, look at the relative strength. I don't like taking chances with stocks that are not performing well. If I was in this stock, which I wouldn't have been, I'd have been worried about holding a stock like this into earnings. But if I was somehow in this stock, I would pay very close attention to how this stock, not only where it opens, but how it trades after that. If it opens above 105, then I think the odds are beginning to move more in its favor. If it opens below 105, I think eventually we're going to work our way back down to the 90 level. All right. Well, let me give you, I'm going to give you two others because these were both portfolio stocks of ours. So MGNI, I'm going to do them really quick because we're running out of time here. But MGNI Magnite, they came out, they beat 19 cents versus 17 cents. It's up 0.5% after hours. And then Viacom, VIAC, also beat $1.04 versus $1.01. And they're down a fraction, less than 1% after hours. Very strong AD line. All right, let's move on. I want to show you three breakouts in the three you must see. So we'll go through them very quickly. Clean Harbors, AD line starting to turn up. Look at this sideways action, volume picking up, and we break out. I think Clean Harbors is now in an uptrend. It has been leading its waste and disposal services peers. So CLH looks good. Next up, Parker Hannifin. This is an industrial machinery company. Stock sideways for the last 3 or 4 months. Look at the volume picking up. We make the breakout AD line, highest level in about 5 months. PH looks good. And the last one I have for you today is Vulcan Materials, VMC. The stock AD line taking off. Nice cup. Come up here. See that cup? Handle, breakout, volume picking up. Looks solid. That's it for me. Everybody have a great rest of your week. I'll be back at Earnings Beats on Monday at 9 a.m. for your next Trading Places Live. Take care, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.